In 2007, I met a man named Robert at an investment conference in Los Angeles. He was 62 years old, had worked for the same company for 38 years, and had just learned his pension was being frozen. Not eliminated entirely, but frozen at current levels with no future accruals. He had about $340,000 in his 401k, a paid-off house worth maybe $450,000, and Social Security coming in 3 years. He asked me a question I'll never forget. "Howard, I did everything right. I worked hard. I saved what I could. How am I supposed to retire now?" 6 months later, the financial crisis hit. His 401k dropped to $180,000. He panicked and sold everything in March 2009. That decision cost him his retirement, not the pension freeze, not the market crash. His decision to sell at the bottom because he didn't understand the principles I'm going to share with you today. That conversation haunted me because Robert represented millions of Americans who played by the rules and still found themselves in trouble through no fault of their own. Before I continue, I need to know who I'm talking to. Drop your age and your current retirement savings in the comments. Don't worry about judgment. I need to understand where you are so I can help you get where you need to be. And if you're serious about achieving financial security after 60 without a pension, subscribe now. This channel isn't about hot stock tips or cryptocurrency schemes. It's about defensive investing, risk management, and the kind of second-level thinking that's preserved wealth through 8 market cycles. Now here's what I'm going to show you in the next several minutes. The 5 fundamental principles that matter more than any investment return. How to position yourself for uncertainty rather than predicting the future, and the specific framework we use at Oaktree to protect capital while still achieving growth. But you have to stay until the end, because the 5th principle is the one that most people never learn until it's too late. Let me start with what most people get wrong about retirement without a pension. They think it's primarily an investment problem. They've been taught they need higher returns to make up for lost pension income. Every financial advisor shows them Monte Carlo simulations proving they need 7% annual returns or they'll run out of money. But here's what 5 decades of investing actually shows. The people who achieve financial security after 60 without pensions don't do it through higher returns. They do it through lower losses. This isn't opinion. This is pattern recognition across multiple market cycles, different economic environments, and thousands of investor outcomes I've observed. And it all comes down to understanding that retirement without a pension isn't an accumulation problem anymore. It's a preservation and distribution problem. Not how much you can make, but how much you can keep and how long you can make it last. I'm going to break this down into 5 principles. Each one builds on the last. Miss one, and the system doesn't work. Master all 5, and you'll have what Robert didn't have in 2008, a framework for making decisions that protects you from yourself and from the market. Let's start with the principle that most people learn too late, usually after they've already made the fatal mistake. The foundation principle is this: after 60 without a pension, your primary job is not to lose money, not to make money, not to beat the market, not to achieve impressive returns, to not lose money. This sounds simple, but it's actually the most profound shift in thinking that most people never make. They spend 40 years in accumulation mode, where losses can be recovered through time and additional contributions. Then they hit 60 with no pension, and the rules have completely changed, but their mindset hasn't. Here's what most people do. They look at their savings, divide by the number of years they expect to live, realize the math doesn't work, and conclude they need to take more risk to generate higher returns. They move money from bonds into stocks. They chase dividend yields without understanding the underlying business risk. They invest in things they don't understand because someone told them it's a retirement income strategy. This is exactly backwards. And here's why. When you're over 60 without a pension, you have 3 sources of income: Social Security, your investment portfolio, and potentially part-time work. Social Security is fixed. Work income is limited and uncertain. Your portfolio is the only variable you control. If you lose 30% of that portfolio, you don't just lose 30% of your wealth. You lose 30% of your income-generating capacity for the rest of your life. You can't earn it back through salary increases. You can't make additional contributions. You can't wait 10 years for recovery because you're spending the portfolio down every year. I saw this play out in devastating detail in 2008 and 2009. I watched people who had done everything right, saved diligently, reached 60 with $500,000 or $700,000, saw their portfolios drop 40%, panicked, sold everything, and locked in permanent losses they could never recover from. The investors who understood this principle, who had positioned defensively going into the crisis, who maintained their discipline during the panic, they not only survived, but eventually thrived. This wasn't luck. This was understanding that the first rule of investing after 60 without a pension is don't lose money. The second rule is don't forget the first rule. At Oaktree, we've built our entire investment philosophy around this concept. We call it defensive investing. In 2005, 2006, 2007, when everyone else was using leverage, chasing yields, taking excessive risk, we were raising cash, being patient, accepting lower returns in the short term to avoid losses in the long term. Our investors questioned us. The media criticized us. Other firms were showing 15% and 20% annual returns, while we were generating 6% and 7%. But we understood the principle. In investing, especially in retirement investing, it's not about how much you make when things go well. It's about how much you keep when things go badly. Now here's the second level thinking that most people miss. First level thinking says, I need higher returns to make up for not having a pension. Second level thinking asks, what happens to my retirement if I pursue higher returns and suffer a major loss? When you ask that question, you realize the asymmetry is brutal. A 30% gain followed by a 30% loss doesn't leave you even. It leaves you down 9%. And that's before considering that you're withdrawing money every year, which means losses compound even faster. This is what separates successful retirement without a pension from failed retirement without a pension. Not intelligence, not market timing. Understanding that preservation comes before growth. So what do you actually do? First, calculate your minimum income requirement, not your desired lifestyle, your minimum. Housing, food, healthcare, basic transportation. Add 20% for unexpected expenses. That's your floor. Second, ensure that Social Security plus any guaranteed income covers at least 60% of that floor. If it doesn't, you need to adjust your floor or find part-time income. Third, structure your portfolio so that the portion generating income to fill the gap between Social Security and your floor is in assets that can't lose significant principal, not can't lose any principal. Inflation-protected bonds can fluctuate, but can't lose 30% or 40%. This might mean accepting 3% or 4% yields instead of chasing 6% or 7%. That's the price of security. You can start this analysis today. Write down your monthly expenses. Separate needs from wants. Calculate your Social Security. Identify the gap. That gap determines everything else. But this foundation alone isn't enough because even with defensive positioning, you still need growth to keep pace with inflation and maintain purchasing power over 20 or 30 years. Which brings us to the second principle, and this is where most people make their second major mistake. The framework principle is this. You need a 3-bucket system, not a single portfolio. Most people think about retirement savings as one pool of money that needs to generate income. This is dangerous because it forces you to make trade-offs between safety and growth across your entire portfolio. The 3-bucket system solves this by separating your money based on when you need it and what job it needs to do. Bucket 1 is your immediate needs bucket. This covers 2 to 3 years of expenses that aren't covered by Social Security. This money goes into treasury bills, money market funds, short-term CDs, things that can't lose principal and are immediately liquid. Yes, the returns are low. That's not the point. The point is certainty. When the market drops 30%, you don't have to sell anything. You live off bucket 1 while you wait for recovery. Bucket 2 is your medium-term bucket. This covers years 3 through 10 of retirement. This money can be in a balanced portfolio of investment-grade bonds, dividend-paying stocks, maybe some real estate investment trusts. The goal is modest growth with moderate risk. You're not trying to double your money. You're trying to generate 4% to 6% annually with limited downside. Bucket 3 is your long-term growth bucket. This is money you won't touch for at least 10 years. This can be more aggressive. Stocks, potentially some alternatives, things with higher return potential but also higher volatility. Because you have a 10-year time horizon, you can ride out market cycles. Here's what most people do wrong. They mix everything together. They have $500,000, they put it all in a 60-40 portfolio, and they withdraw 4% annually regardless of market conditions. When the market drops, they're selling stocks at depressed prices to fund living expenses. They're turning temporary market losses into permanent realized losses. I watched this destroy retirements in 2008. People who needed to withdraw $30,000 for living expenses were forced to sell stocks when the market was down 40%. They sold twice as many shares as they would have sold a year earlier. Those shares never came back into their portfolio. The recovery happened without them. The three-bucket system prevents this. In 2008, if you had 2 years of expenses in Treasury bills, you didn't have to sell a single share of stock. You lived off bucket 1, you let bucket 3 recover. By 2010-2011, when stocks had recovered, you could refill bucket 1 from bucket 3 at much better prices. At Oaktree, we think about this constantly in our distressed debt strategy. We don't keep all our capital invested all the time. We maintain dry powder cash reserves specifically so we can deploy when opportunities arise. In 2008, we had raised $11 billion specifically to invest during the crisis. We weren't smarter than everyone else. We just understood that having capital available when prices are low is more valuable than being fully invested when prices are high. The same principle applies to retirement. Having 2 years of expenses in cash when the market crashes is more valuable than having that money invested and having to sell at the bottom. Now, here's the second-level insight. First-level thinking says, cash is trash, it earns nothing, I'm losing to inflation. Second-level thinking asks, what is the option value of having cash when everyone else is forced to sell? And when you ask that question, you realize that cash isn't an investment, it's insurance. It's optionality, it's the thing that lets you be patient when everyone else is panicking. So what do you actually do? Take your total retirement savings. Calculate 2 years of expenses beyond Social Security. Put that amount in Treasury bills or a money market fund. That's bucket 1. Calculate 8 years of additional expenses. Put that amount in a conservative balanced portfolio, maybe 40% investment grade bonds, 40% dividend paying large cap stocks, 20% in REITs or other income generating assets. That's bucket 2. Everything else goes in bucket 3 for long-term growth. Diversified stock portfolio, maybe some international exposure, maybe some alternatives if you understand them. Rebalance once a year. When bucket 1 gets low, refill it from bucket 2 or bucket 3, whichever has performed better. This isn't complicated, but it requires discipline. Most people can't maintain this structure because they see bucket 1 earning nothing, and they want to invest it for higher returns. That's how people lose their retirement. You can set this up this week. Most brokers will let you create separate accounts or at least separate positions within one account. But the 3-bucket system only works if you understand the third principle, and this is the one that causes more retirement failures than any other single factor. Most people don't see it coming until it's too late. The protection principle is this: sequence of returns risk will destroy you if you don't plan for it. This is the most underestimated danger in retirement without a pension. Here's what it means. 2 people can have identical average returns over 20 years and end up with completely different outcomes based solely on when those returns occur. If you retire and the first 5 years give you strong returns, you'll likely be fine. If you retire and the first 5 years give you negative returns, you might never recover even if the next 15 years are excellent. This is because you're withdrawing money every year. Losses early in retirement, combined with ongoing withdrawals, create a hole that's almost impossible to climb out of. Let me show you this with numbers. Person A retires in 2000 with $500,000. The next 3 years, the market drops 40%. They're withdrawing $25,000 annually for living expenses. By 2003, they have about $220,000 left. Even if the market doubles from there, they're still behind. Person B retires in 2010 with $500,000. The next 3 years, the market rises 50%. They're withdrawing the same $25,000 annually. By 2013, they have about $680,000. Even if the market is flat from there, they're fine. Same withdrawal rate, same average returns over the full period, completely different outcomes. This is sequence of returns risk. I watched this destroy people who retired in 2000 and 2001. They had done everything right. They had saved, they had diversified portfolios, they were following the 4% rule. But they retired right before a massive bear market. The combination of market losses and ongoing withdrawals devastated their portfolios. Many of them never recovered. They had to go back to work in their late 60s and early 70s. Not because they were bad investors, because they were unlucky with timing. The investors who understood sequence of returns, risk positioned differently. They had larger cash reserves. They reduced equity exposure in the years leading up to retirement. They were willing to accept lower returns in exchange for protection against early losses. When the bear market hit, they had options. They could reduce withdrawals. They could live off cash. They could wait for recovery. At Oaktree, we think about this in terms of permanent versus temporary capital. Permanent capital, like our closed-end funds, can ride out market cycles because there are no forced redemptions. Temporary capital, like open-end funds, faces redemption risk during downturns. In retirement without a pension, you have temporary capital. You're redeeming it every month for living expenses. That changes everything. Here's the second level thinking. First level thinking says, I'll just invest in a diversified portfolio and take systematic withdrawals. Second level thinking asks, what happens if I retire right before a major bear market? And when you ask that question, you realize you need a specific strategy for the first 5 to 7 years of retirement. That's the danger zone. That's when sequence of returns risk can destroy you. So what do you actually do? First, in the 5 years before retirement, start building your cash bucket aggressively. Don't wait until retirement day. Start at 55 or 56. Second, in the first 7 years of retirement, if the market drops more than 20%, cut your discretionary spending by at least 25%. This is hard but essential. The market will recover. Your portfolio might not, if you keep withdrawing at the same rate during the decline. Third, consider working part-time for the first few years of retirement. Even $15,000 or $20,000 a year in part-time income dramatically reduces the amount you need to withdraw from your portfolio, which dramatically reduces sequence of returns risk. This is the difference between making it and not making it. You can implement this starting today. If you're 55 or older and planning to retire in the next few years, calculate how much you're adding to your cash bucket each month. If it's not at least 20% of your contributions, adjust. But even with all of this, defensive positioning, 3-bucket system, sequence of returns protection, you're still vulnerable if you don't understand the fourth principle. And this is where I see the most expensive mistakes, the ones that cost people not just returns, but decades of financial security. The expense principle is this: every dollar you don't spend is worth more than every dollar you earn. This sounds obvious, but people don't behave as if they believe it. They focus obsessively on investment returns, on finding the right allocation, on beating the market by an extra percentage point. Meanwhile, they're hemorrhaging money on expenses they don't need and fees they don't understand. Let me be specific. If you're 65 with $400,000 in retirement savings and you reduce your annual expenses by $10,000, that's equivalent to having $250,000 more in savings at a 4% withdrawal rate. Think about that. Cutting $10,000 in annual expenses has the same impact as somehow finding $250,000 more to invest. Which is easier? I see people with $500,000 in retirement savings paying 1.5% in investment fees because they're working with an advisor who puts them in expensive mutual funds. That's $7,500 a year. Over 20 years at 6% returns, that's not $150,000 in fees. It's over $275,000 in total cost, including lost compound growth. That's more than half their starting portfolio. Gone, not to market losses, to fees. Here's what most people do. They pay attention to their investment returns and ignore their expenses. They'll spend hours researching whether to buy this stock or that bond. Meanwhile, they're paying $150 a month for cable they barely watch, $80 a month for a gym membership they don't use, $200 a month for a car they don't need. That's $5,160 a year, or $129,000 over 20 years at a 4% withdrawal rate. I'm not saying live like a monk. I'm saying be intentional. Every recurring expense should justify its existence every year. Every investment fee should be negotiated or eliminated if possible. Every discretionary purchase should be weighed against the alternative of having that money compound for another year. At Oaktree, we're obsessive about fees and expenses. Not because we're cheap, because we understand that fees are the one thing we can control. We can't control market returns. We can't control economic cycles, but we can control what we pay. And over long periods, controlling fees matters more than predicting markets. Now here's the second level insight. First level thinking says, I deserve to enjoy my retirement. I worked hard. I should spend on things that make me happy. Second level thinking asks, which expenses actually increase my happiness and which are just habits? And when you ask that question honestly, you realize most people are spending money on things that don't meaningfully improve their lives. They're spending because they always have, not because it matters. So what do you actually do? First, track every expense for 3 months, not to judge yourself, to understand where the money actually goes. Second, categorize expenses into 3 groups: essential, important, and nice to have. Be honest. Cable is not essential, healthcare is essential. Third, eliminate or reduce everything in the nice to have category that you wouldn't pay twice as much for. If you wouldn't pay $300 a month for that cable package, you shouldn't pay $150. Fourth, move all your investments to low-cost index funds or ETFs, unless you have a compelling reason to pay higher fees. If you're paying more than 0.5% in total investment fees, you're probably paying too much. This could save you $100,000 or more over your retirement. You can start this tonight. Write down your 10 largest monthly expenses. Ask yourself, would I pay double for this? If not, it's a candidate for reduction or elimination. But everything I've told you so far, all 4 principles, they all depend on the 5th principle. And this is the one that separates people who achieve financial freedom after 60 without a pension from people who struggle. This is the principle I wish Robert had understood in 2007. The discipline principle is this: you need a decision-making framework that protects you from yourself. All the strategy in the world doesn't matter if you abandon it when things get scary or exciting. And things will get scary. There will be another bear market, there will be another crisis, there will be another period where everyone around you is making money in something you don't own, and you'll feel stupid and left out. There will be another period where everyone is panicking and selling, and you'll be terrified. Your ability to stick with sound principles during those periods will determine your outcome more than any other factor. Let me tell you what happens to most people. They set up a good plan, they have their 3 buckets, they understand sequence of returns risk, they've cut their expenses, then the market drops 30%. They watch their portfolio shrink, they watch the news talking about recession, they see their neighbors selling, and they panic. They abandon the plan, they sell at the bottom. Or the opposite happens. The market goes up 50%. They watch their neighbors making a fortune in some hot investment. They feel stupid for being defensive, and they abandon the plan. They buy at the top. I've watched this cycle repeat for 5 decades. Smart people, good plans, destroyed by emotional decision-making at exactly the wrong time. The only solution is a framework that removes emotion from decisions. Here's the framework that works. Before you make any significant financial decision, retirement, investment, major purchase, ask yourself 5 questions. First, does this decision align with my 3-bucket system? If you're thinking about putting more money in stocks because they're going up, but that money is supposed to be in bucket 1 for near-term expenses, the answer is no. Second, am I making this decision based on fear or greed? If yes, wait 72 hours and ask again. Third, would I make this same decision if the market was doing the opposite of what it's doing now? If you want to sell because the market is down, would you want to buy if it was up? If you want to buy because it's up, would you want to sell if it was down? Fourth, can I explain this decision to someone who doesn't follow the market? If you can't explain it simply, you probably don't understand it well enough to do it. Fifth, what would Howard Marks do? I'm serious about this one, not because I'm always right, but because asking what a disciplined, cycle-aware, risk-focused investor would do forces you to think beyond your emotions. At Oaktree, we have an investment committee specifically to prevent emotional decision-making. No single person can make major decisions alone. We force ourselves to articulate our reasoning. We challenge each other. We document our decisions so we can learn from them later. You need the same thing. Maybe it's a spouse, maybe it's a friend, maybe it's a written set of rules you commit to following, but you need something external to yourself that prevents panic selling and greed buying. Here's the second level thinking. First level thinking says, I'll just stay disciplined. Second level thinking knows that everyone thinks they'll stay disciplined until they're in the middle of a crisis or a bubble. And when you know that about yourself, you create systems that enforce discipline even when you don't feel disciplined. So what do you actually do? Write down your 3-bucket allocation today. Write down the specific circumstances under which you'll rebalance. Once a year on your birthday, when any bucket is more than 20% above or below target, whatever rules make sense. Then commit to following those rules regardless of what the market is doing. Second, identify one person who will be your discipline partner. Someone who will talk you out of panic decisions. Give them permission to challenge you when you want to make emotional moves. Third, write down this sentence and put it somewhere you'll see it. The market will recover. My portfolio might not if I sell now. That sentence could save your retirement. You can do all of this today, right now. before you go to bed tonight. So here's where we are. You're over 60 with no pension. You have Social Security and whatever you've saved. The question is, will it be enough? And the answer is, it depends entirely on whether you follow these 5 principles. Don't lose money. Use a 3-bucket system. Protect against sequence of returns risk. Minimize expenses. Maintain discipline. These aren't complicated, but they're hard. Hard because they require patience when everyone else is getting rich quickly. Hard because they require courage when everyone else is panicking. Hard because they require discipline when your emotions are screaming at you to do something different. Most people will read this, nod along, and change nothing. They'll go back to checking their portfolio every day, worrying about returns, chasing performance. They'll make the same mistakes Robert made. They'll lose money they can't afford to lose at a time when they can't recover from losses. Don't be most people. Before you go to bed tonight, calculate your 2-year expense reserve. Write down the number. That's your bucket 1 target. That's your first step toward financial freedom after 60 without a pension. And drop a comment right now with your age and whether you have a pension or not. Public commitment increases follow-through. Use it. Subscribe if you haven't already, because this channel is about the kind of thinking that preserves wealth across market cycles. The kind of thinking that took me 50 years to develop and that you can learn in months if you pay attention. Financial freedom after 60 without a pension is possible. But only if you understand that it's not about getting rich, it's about not getting poor. It's not about maximum returns. It's about minimum regrets. It's not about being brilliant. It's about being disciplined. That's what 5 decades of investing teaches you. That's what surviving 8 market cycles shows you. That's what building Oaktree Capital proves. I can't do it for you. I can only show you how. The rest is up to you.